Maybe not everyone knows that Moschino also wants to cover himself from the currency risk in the future. If he opened a sell position on the euro dollar, bringing the bag to US, he should have opened a buy position in euro dollar in Forex. So Moschino and everyone who brings good to US do Forex. They are the famous commercial. We will see them in the other part of the video called timing chart. If they don't want to hedge themselves, they will expose themselves to the exchange risk. If they hedge themselves, they need to open an opposite position. So if the bag value increases because the dollar raised up, they have sold the bag and bought dollars for the same amount in Forex. In this way, they guarantee their profit. If the bag value decreases, they have to buy dollars to balance the bag sell loss. Why is this important? Because opening a buy position of the same amount of the bag value, it will cancel the exchange risk variation. Maybe not everyone knows that if the dollar increases, the bag value in dollar increases respect its euro value. In this case, the buy position opened on euro dollar will lose the same value of the bag. Maybe not everyone knows that if the dollar decreases, the bag value in dollar decreases respect its euro value. In this case, the buy position opened on euro dollar will earn the same value of the bag. The one who brings the goods to US is not interested to earn money more or less from the Forex on euro dollar. Why? Because if he has a large margin, it's not important exchange variation, even though it's crazy. Because a cross can change more or less 26% its value. Let's think. So even though he has a big margin, he can earn 4 times more the product value. He has a 25% profit on top of what he has earned in 1 year. What do I need to do to cover the imported goods when I exported them? I close the hedging position when I bring home the profit. It's not so easy, but there are companies specialized on this. If, for example, there is a petrol boat out of the origin country for 6 months, there are 2 problems. First, I need to cover the oil from the exchange. Second, the oil is in dollars, so I need to cover also the dollar currency. Otherwise, the boat will arrive to the destination and the value of the boat can be a loss. Okay? So I need to hedge the commodity oil, hedge the dollar currency. If instead it's a good, I don't need to hedge it, but just to hedge from the currency exchange risk. The Forex market offers the possibility for the ones who need to do exchange hedging for export, import, raw material, purchasing gold, oil, etc. Is your trading account in dollar? For the ones who make options, which I think is the most flexible tool existing, however people are running after Forex, they earn or lose making options, not because they have a dollar account. If you do option and not Forex, you don't want an exchange risk. So, what do you need to do? If you have a dollar account for $10,000, it's like opening a sell position on euro dollar for the same value. How can you cover yourself? You open a buy position for the same value. Forex is useful. If people are using Forex to hedge themselves from the exchange risk of their account, exporting goods, commodities, or any other reason, you can see a 20 big pips candle in 1 minute in the market. It's not speculation, but just hedging. So if someone needs to hedge goods for a long time, they will need to buy currencies for a long time. People are saying Forex is dangerous. Forex is used as an insurance to cover risk. These people who needs the exchange hedging are the commercials. They need to hedge the commodities, futures or goods they have. They do this to protect themselves from the speculation of the market. If they need to hedge a whole boat, they will buy futures that expires in 1 year and assure them the oil value and their profit. They don't know if the oil price will go up or down, but they want to have the same oil price for 1 year. If you want, for example, 100 iPhones in 1 year for the same price, you are kinds of making a future contract or expiring option. Price and expiring date. If the goods like iPhone are quoted in the CBO, you need to buy 100 iPhones with an expiring price in 80, 100 or more days. Because most of the goods are not quoted, you need to call the supplier and make a contract. Instead, when goods are quoted on the CBO, you can make the contract on the CBO, which is the Chicago Exchange Board Office. You can ask the goods if you are commercial. Why all this? Because the market is at the mercy of the speculation and people need to defend themselves from the speculators, like the commercial. We will see this phenomenon in the timing chart part of the video. The positions opened by the commercials are the same to the ones opened by the large traders and small speculators. So these information are published weekly on the CBO and you can have them for free in timing charts. If your account is in euro, your broker every time you close a position will exchange dollar into euro. When you operate in the Forex market, your profit is on the denominator currency of the cross. So, for example, euro dollar, dollar. The profit is in dollar. If your account is in dollar, the broker calculates your profit without exchanging them. Good. So, in this way, you understand why everyone operates or is involved in the Forex market. The currency exchange is one of the most important needs in every kind of activities. Import-export, for example, one of the most important countries for import-export is USA. All transactions are in dollars, so it's essential to operate in the Forex every day, every moment. For Europe, from 9 to 17, GMT plus 1. For US, from 15 to 23. For Asia, from 2 to 10. For Australia, when they are the only one. It's possible to do hedging with a low or high market volatility. What's the swap? This is an essential concept. If you open a long position, so bullish on euro dollar, you believe that euro will go up and dollar down. The position gives you the right to collect the approved rate on the euro. There is a tab which you can see in hundreds of websites where you see the currency's interest rate. For example, euro 1%. So if you buy one lot, so $100,000 with leverage 1 to 500, you will make 1% in 1 year, which means $1,000. The problem is when you buy euro, you also sell dollar. So one lot, $100,000, which means $1,000 per year profit. you will need to subtract the approved dollar rate. So for example, today the dollar rate is 0.25% per year, which means you lose from one lot $250 per year. The result is $1,000 minus $250 equal $750. That's your profit. This means you will have a guaranteed profit of 0.75% per year. This profit will be uploaded to your account every day in the swap voice. If you are selling dollar, every day you will see 0.75% per year more on your account. On the opposite case, you will see every day 0.75% less on your account. This technique is called carry trade. So, the purchase of the cross currency that guarantee a profit. Clearly, the reference currency fluctuation in the value of currencies are well above the rate you can cash. It's not difficult to imagine that fluctuation in the value of currencies are well above the rate you can cash. It's like when you buy a stock with a 3% dividend. If the stock goes down 30%, you cash 3% but lose 27%. One of the favorite cross for carry trade is Euro Swiss franc, which pays 0.75% per year, and it was therefore the less volatile currency pair. Banks use this very commonly. And where can you find the actual currency rates